Hi there, everybody. Mike Petras here, your star realtor of Star and the Treasure Valley. Back actually with a new episode that I want to come up with, which is called Mikey's Mortgage Monthly Updates. And here we're going to go ahead and talk about what is happening in the mortgage industry when it comes to interest rates and how it may be affecting you being able to buy, sell, or invest right here in the Treasure Valley. So let's get to that information right after this. Welcome back after that short break, everybody. Again, my name is Mike Petras. I'm your star realtor of Star and the Treasure Valley. And basically, I just felt it necessary, and I think that it's going to be a really good addition to this YouTube channel of being able to come up with a monthly market breakdown of what is happening in the mortgage industry and interest rates as in terms of inflation and how is it could be possibly affecting you from being able to purchase a home coming up here in, say, the Treasure Valley, or even really kind of across the United States in itself. So what I went ahead and here and did was broke down an article that was recently made by ABC News talking about the last meeting that the Fed had with Chairman Jerome Powell of the Fed. Okay, now, again, I am not a mortgage professional. I am a licensed real estate agent. So if you do have any further questions, I do recommend that you reach out to a mortgage professional and have a conversation today about how it can affect your overall purchasing power if you decide to make a move here, say, to the Treasure Valley or the greater Boise, Idaho area. But in terms as a realtor, I still pay attention to what inflation rates are doing to the interest rates, because I know that also affects you as it comes across from your purchasing power. So it's something that I do want to go ahead and cover. So let's go ahead and let's dive into this and let's talk about what he had basically said. So during this meeting that they had back on the 21st of March, the Federal Reserve basically made a lot more of a hard-nosed stance at what is happening with inflation rates here in the United States. Of course, if you've been paying attention, you do know that inflation is at the highest it's been in the last 40 years, and it doesn't look like that train is stopping anytime soon. And really, the only way to stop the train is to raise in interest rates, okay, and take some of that money out of circulation. We'll kind of dive into some of the reasons as to why our inflation rate is the way that it is right now, and tackle one of the subjects as we go a little bit later on in this video. But in the meantime, the Federal Reserve said that they would raise its benchmark short-term interest rates faster than expected and high enough to restrain growth and hiring if it decides this would be necessary to slow rampaging inflation. So basically, to break it down, they said that they would raise their key rates from a quarter point from a near zero to a range of 0.25 to 0.05%. So what they were basically saying is every time that they would meet, coming up in the multiple times that they said they were going to meet during this year, that they would basically raise it only about a quarter point every time they did. Well, now, according to this article, they're kind of changing their tune and saying that they go up 0.5% or 50 basis points every single time that they meet. So, Mike, you're probably saying, hey, Mike, well, how many times are they going to meet? Well, that has been kind of all over the board. I heard 7 times at the beginning of this year. Then after the Ukraine war, I've heard it was started. I heard 12 times. Now, according to this article, they're going back down to 6. You can always look online and you can go to the Federal Reserve and take a look at how many times they're going to meet. But again, what are they going to be talking about? And most of the time, this subject is probably going to come up. So we'll just have to really kind of pay attention and see how many more times that they are going to meet. But let's just go ahead and take them at face value and says that they're going to do it another 6 times. But again, I just want to reiterate that the central bank would be open to raising rates by a comparatively aggressive half point at multiple Fed meetings. This would be the first time that they've gone up to a half point since May of 2000. That's very, very aggressive. And again, if they're going up, 0.5% every time that they meet now in 2022, this is just more money that's going to be coming out of your pocket, which will adjust your buying power if you're a buyer out there. Another thing that they did say is they could go so far as to send rates into restrictive territory that would slow economic growth and possibly raise the unemployment rate. I'm not going to go ahead and touch that one for this kind of basis. I just want to go ahead and level off to how this can affect you as a buyer, a seller, or an investor looking to move around the U.S. or here to the Treasure Valley or the greater Boise, Idaho area. So moving on to the next slide here, once I can get to it. Sorry about that. Okay. So in particular, they said if they conclude it's appropriate to move more aggressively by raising the federal fund rates by more than a quarter point at a meeting or meetings, which we talked about. So they're still kind of teeter-tottering on the fence as to whether or not they want to go a quarter point or a half point. But if anything kind of feels anything, if you're looking at, gas prices rising, your food prices rising, everything rising around you, for commodities, I would think that they would probably have to take more of an aggressive stance, and I would be more or less willing to say that they'll probably think about the 0.5 basis, the 50 basis point or the 0.5% increase rather than the latter. But again, I just wanted to highlight too that they said that they would raise rates 6 more times this year and 4 more times in 2023. But really, where's that one going to land? A normal market, they really don't want the inflation rates to be any more than 2%. That's basically the sweet spot for the Fed. But they are projecting that inflation could slow to 2.7% by the end of next year if they continue to do this. But according to the NAB survey of its member economists, 77% think that the Fed's interest rate policy remains too low as it stands right now. They think that they need to be more aggressive. And they said nearly the same proportion said they believe inflation will remain at 3% or above 3% next year. So basically what they were saying is that they're just saying that the Fed is not being aggressive enough in order to combat the inflation rates that we're seeing currently right now. And basically what the Fed is trying to come in and say is that they think that they can do a soft landing with all this, but some of the economists that are talking about this are saying that a soft landing is unrealistic given the challenges that the economy faces right now, all the way from the Russian invasion of the Ukraine and cost of oil, wheat, nickel, etc. So who we really kind of believe in right now, is maybe the Fed still, even though the Fed is not really not a political entity and shouldn't be a political entity, but to think that, maybe that they're taking this softer, on some sort of political level, that also could be, in the cards of what's really happening here. But when you have 77% of the economists, saying that they're taking it a little bit too easy, we really need to kind of think about that in terms of interest rates as it goes along. So the next slide here, I just kind of wanted to briefly recap where we're basically at right now. So at the beginning of 2022, our interest rates were still just slightly above 3%, which are still really nice. But since the beginning of January, as you can see, they've just absolutely skyrocketed through the roof. And there's no return in sight from what it looks like. It could take multiple years before the interest rates actually do come back down. So again, buyers, if you've been on the fence about buying, now I would say is your time to get in there, because the other thing that you're facing right now, due to low inventory that we're seeing, especially here in the Treasure Valley, and still a high demand for people wanting to come out here, we're also still seeing home prices rise. And you can see that in my last episode of Mikey's monthly market updates that goes ahead and covers what is happening in the real estate market right here in the Treasure Valley. But again, interest rates are going up, which just means more money out of your pocket. It's a double whammy that you could possibly be seeing, which I don't want you to see. So again, if we're taking a look all the way back, from just February of 2023, we can see that the basis for the interest rates have already jumped up more than 0.5% just in a month. Okay. And it's going to continue to go up, especially if they're talking about meeting another 6 times per year. Okay. And they're going to possibly raise the interest rates 0.5% every time they do. So again, it could reduce your purchasing power. I do say if you are in the market to purchase right now and you want to make, say, even a relocation here to the Treasure Valley or the greater Boise, Idaho area, reach out to your mortgage professional today. Have a conversation with them and start setting the foundation while you can. Renters, again, too, if you've been saving up money to put down, 10, 20%, or however much you want to put down, even 3.5% if you're going for FHA. Again, the interest rates are just going to reduce your buying power. So again, talk to your mortgage professional right away. Okay, so what I wanted to go ahead and show here is really how this, does affect down the long run. So in this example, let's say that you're looking at a home loan of $200,000. Of course, we know the median home prices here in the greater Boise, Idaho area, let's say Ada and Canyon County, is much higher than $200,000, but at least it's going to give you a gist of what's going on. So if you get a 30-year fixed mortgage and you put down payment of 20%, okay, or basically roughly $40,000, you'll have a $160,000 mortgage. Okay, if you only put down 10%, you can go ahead and read that. But let's just kind of focus on, what you're going to be paying in interest over the 30 years if you are at these particular numbers. Now, I know that right now we're higher, okay, than 4.5% according to the last chart, but this just kind of gives you a breakdown. So at 3.5%, basically you're looking at $98,650 that you'd be, spending over the course of the 30-year interest. But as the interest rates go up, you can see that number is going up, which just adds to your monthly mortgage payment. And again, we kind of just don't know where they're going to stop for 2022. But at worst case scenario, let's say 6 more times at a half a point, that would put us pretty high. And I think you guys can do the math on that one. So again, also, if you're not putting down 20%, you're going to be also subject to what's known as PMI. And that's just an extra fee that's tacked onto your mortgage as a mortgage insurance. So, again, it can just cost you more money, in terms of, the home price overall, the interest rates, and then this isn't even factoring in property taxes and stuff like that. So just know, getting in earlier as these interest rates still stay low is a great, great, great thing. So buyers and even sellers, if you're thinking about making a lateral move into another home, say elsewhere in the United States, this still is going to apply to you. So get in there while you can, sell your home and make that lateral move, lock in that interest rate. So you're not spending extra money for really no good reason whatsoever, except to take, cash out of the economy, which needs to happen. Okay. So after we've kind of dived through that, I just kind of wanted to dive into, okay, some of the reasons why we're seeing, inflation as high as we're seeing it. Now, these are just, some of what I've seen, as we've gone along and kind of broke it down into some points. Of course, it's not going to cover everything. So if you'd like to comment below and get involved in the conversation, let's do it. Let's absolutely talk about this because, knowledge is power, everyone. And the more that we talk about this as a community, the more that everybody knows kind of what's really going on and what's the right thing and what isn't the right thing in a lot of cases. But one of the biggest things that created, our inflation rate is that we dumped $5 trillion, plus that was injected into the economy to economically combat the COVID-19 pandemic. And that money was basically unbacked by anything. It was just printed and tossed out there. If you know anything about, the end of World War I, when the Germans had lost, the Germans were basically printing up money to pay for their reparations and just flooding the economy with it. And unfortunately, a bucket full of cash at one point couldn't even buy you a loaf of bread. It wasn't backed by anything. It wasn't worth anything. So again, that had something to do with rising inflation, is that more currency that we throw in, the less our dollar's worth. And there you go. Another thing was the stimulus money that was received by us consumers generally was not spent on services rather than goods. So buying up all these goods created a limited supply with a consistent demand. the United States, we're still one of the largest consumers, if not the largest consumer in the entire world. So our demand is constantly there. And when the ports had to close, essentially due to the pandemic, reducing goods and supplies and breaking current supply chain, resulting in broken current supply chains too, less materials were available that were needed to create domestic goods, as well as disruption in imports. Demand still remaining high and from the American people. Again, just like it is with housing, less available inventory and still a high demand is just going to raise the prices and result in inflation and in price increases, which is something that we've seen. Another one of the big factors, American independent energy was essentially cut off as a campaign promise by the current administration, the Biden administration. For example, the Keystone pipeline was shut down. Fracking was shut down. Basically, American independent energy or American oil was reduced semi to rubble. Okay, and that resulted, more or less in kind of like a political agenda, in the sake of not getting involved in politics. I think that you kind of know where this one is going. But what it did was it forced the U.S. Seeking oil imports rather than relying on American energy. And if you don't have American energy being able to kind of compete with, say, gas prices around the world, being able to, compete and be able to balance the oil prices, across here in the United States. So basically, we're at the mercy a little bit here of what these countries are supplying to us and what they want to charge us. And if we don't have American oil to be able to, compete with that and kind of keep those prices low, well, then you are seeing what's happening, with inflation, because those gas prices are trickling down. The gas prices are surging other essentials like foods and goods, rising to the increase in the gas prices, but also the broken supply chain has a lot to do with this. So really, it's kind of almost a perfect storm for inflation rates the way that they are. Broken supply chains and high gas prices, which is trickling down to everything else. It is just really, now you can really see why our inflation is just going through the roof. And again, these are just some of the factors. I'm sure there's more factors out there that are resulting in the inflation rates. So please comment below. Let's talk about it. But again, I took this from the other article that we had before. They said, additionally, raising interest rates does not fix the supply chain. We need the supply chain back. Until that gets resolved, we're not going to be able to fully solve inflation. So even though the pandemic has basically been eliminated throughout the US, or a little bit to that point, I'm sure that you got some things to say about that. But either way, some of these are coming. A lot of these broken supply chains are starting to resolve themselves, a bit. But what's kind of keeping them down again is these poor truckers and the poor people that actually have to ship over, these materials across the United States. Now they're paying over inflated gas prices, and it's just kind of keeping this moving along. Okay, so again, comment below. Let's go ahead and let's talk about it. But one of the things in the article that I kind of really want to talk about here is gas prices. Okay, let's go ahead and let's break this down and talk about this. Powell acknowledged that higher oil and commodity prices serve as a reminder of the oil price spike in the 1970s. That was before my time, but I'm sure that some of you know about it, which fed soaring inflation in that decade. It wasn't until the early 1980s, after Chairman Paul Volcker had sent the Fed's rate to nearly 20%, that inflation finally got tamed. Oh boy, let's certainly hope we don't have to go up that high in order to tame this. But remember, back they were saying 77% of the economists were saying that the Fed is taking it a little bit too easy. If they are taking it that easy, is it going to be something that we're going to see in order to kind of correct this surge? Let's hope not. Okay, but Powell did argue that the U.S. economy was less sensitive to oil prices now, in part because it's more fuel efficient. Okay, well, let's go ahead and let's tackle that here real quick. Let's talk about fuel efficiency of new light-duty vehicles. Okay, let's take a look at this all the way back here. Now, back in around 1987 or so, like that, the average fuel efficiency, for these particular types of vehicles was, hovering around, looks like about 22 miles per gallon. Went back down at 12% between the years of 1988 to 2004, and then is rising back up here. Or it started actually hit that point again to basically get at that level that we were seeing back in 1987, around closer to 2010. But yeah, I mean, the efficiency has kind of come back, but the average efficiency for a new light duty vehicle is only looking at about 3 to 5 miles per gallon. Okay. And maybe this is why they're trying to push towards, electric cars. I don't think that's the deal, but, either way, are we really more fuel efficient? According to this graph, it really kind of doesn't look like that's so the case. So that's something to kind of take in mind too, as you're thinking about where interest rates could really land. And then, of course, if we're talking about, oil imports and exports, we do know, and just kind of recapping, that ever since the new administration took over, boom, look at that, in terms of, crude oil exports, and basically our production just kind of went down, and the crude oil imports are coming back up. But here's one little promising sign that I just want to point out over here. Again, this is talking about American, oil production, here in the United States. It did jump down as a new administration took a hold. Boom, just went down. Okay, from what we need, but you can slowly seeing it start to trickle back up. So maybe this administration is kind of knowing now, or maybe it's because an election cycle is right around the corner. Maybe they're kind of knowing that the U.S. public's a little bit upset about where gas prices are really at right now, and maybe they ought to do something about it. Okay, so either way, again, I wasn't really trying to take this away from being a conversation about housing per se. In where interest rates stand, but I just want to kind of put it in perspective to you, where our economy lands right now and why inflation rates are being, just bolstered, where we stand, and why the inflation or the interest rates have to go up to be able to counteract this. So again, it's just something that I'm going to go ahead and keep our eye on, or my eye on, so that I can be able to address you about the interest rates as we go over. But right now, interest rates, what you need to know: buyers, they're on the rise; sellers, they're on the rise; investors, they're on the rise; renters, it's on the rise. So if you've been in the position and you've been getting ready to buy, and you've been on the fence and just like, oh, we'll see what happens with this economy. If you're expecting a 2008 crash, again, that was for totally different reasons. Back in 2008, it crashed because basically of greed and no regulation. And then when it got caught, boom, it all exploded. Okay. That is just not the case anymore. Mortgage professionals now run you through the ringer because the banks are required by the federal government not to do certain predatory loans anymore. So their risk is being in checked, or is being placed in check by the federal government. Okay, so again, a whole different situation. And right now, buyers, especially too, you see home prices back on the rise, along double whammy that with a high interest rate. Again, get in while you can, while interest rates still stay manageable, because right now they could be a lot worse. So just kind of keep that in mind. But let me go ahead and get to my final thoughts about this right after this. We'll get right back to you. All right, so let me go ahead and just kind of break this down in a summary for you. Of course, we all know that inflation rates have just been on the astronomical rise, and we do know that interest rates are going to be the only way that we're going to go ahead and counteract them. So again, buyers, sellers, investors, and even renters, keep this in mind, that interest rates are going to be on the way up because inflation is on the way up and is just undeniable, and there's no way to get around it. Okay, so right now, to kind of put this in a recap from the article, is that Powell said that the Fed is going to get a lot more aggressive. Okay, so maybe during the next multiple meetings that they have, they're going to go up maybe 50 basis points, which is 0.5%, instead of just 0.25% every single time they go through. So what does that mean for you in the long run? It just means that you could be paying more money. So let's go ahead and let's break this down per category. So buyers, again, If you've been on the fence, one of the things that you will see in Mikey's monthly market updates about what's happening here in the Treasure Valley or the greater Boise, Idaho area is we're starting to see some, home values go up again, start to tick up because really just there's no inventory and we still have a high demand. Now, will that flip flop, if the interest rates continue to go up and say go up to astronomical levels? Well, then sure, it possibly could. But even if a market correction is on the horizon, which I still think that it most likely is saving money on saving, maybe even saving, $25,000 or $50,000 in the overall home value going to offset what the interest rates are doing to you? And unfortunately, the answer to that is going to be no. The interest rates are always going to win out and cost you more money in the long run. So right now, interest rates are still hovering, probably around 4.5 right now. They went up more than 4.5 today, according to our slide earlier. Looks like they're at 4.7% right now for a 30-year fixed. Of course, talk to your mortgage professional about that. Again, I'm just a realtor. Perhaps there might be something better out there that you may want to talk to them about and lay the foundation. But either way, right now, as interest rates go up, which they're going to continue to go up, and the Fed has already said that they can aggressively start going up, it's just going to cost you more money, and it really could hurt your buying position in the long run. So again, it's imperative right now that if you've been on the fence or you're having second thoughts as whether or not there's going to be a crash. No, there's no crash coming up, not like 2008. We've already mentioned that. But talk to your mortgage professional today. Reach out, have a conversation, know your buying position before you start going in. And that's what the pre-approval process is for. So buyers, here's your window. And again, I said it in Mikey's monthly market update, and I'm going to say it again in this particular video. Again, here's your window. Get in there and do what you can. Sellers, again, for you right now, between supply and demand, I mentioned this in Mikey's monthly market updates. We are seeing some more equity growth to our area right now, which is good for you. But again, if you're trying to sell and make a lateral move, which you most likely are, okay, you're trying to get into another property, again, now you're in the buyer's shoes and you're going to be subject to the same interest rates. So get in there, get top value for your house while you can, appropriately price it. Bidding wars are starting to come back a little bit because of the inventory shortage. So it's a good opportunity for you to sell, get over there and get in and lock up that rate before it does go up. Renters. Again, renters, if you've been putting away that money and you have not talked to a mortgage professional yet, you really should look at your options that you have in terms of all the different loan structures out there so that you can get in, start shopping today and lock in that rate while you can, while it's still low. Again, it's just going to be more money coming out of your pocket across the board for anybody that's looking to buy. So again, we mentioned that the Fed is going to meet another 6 times, but again, that's been all over the board since the beginning of this year. Who knows what to believe, coming out of the Fed. But if they are going to go aggressive and do a 50-point basis or a half percent up every single meeting that they've got, it could really inflate the inflation rates. And again, I just want to recap that the economists, 77% of them are saying that the Fed has taken it too softly. So will the Fed talk about an even more aggressive stance coming up? So that's just something we'll have to pay attention to. And that's why I'll be coming up with these videos once per month or even once every couple of weeks. So stay tuned. If you do have any further questions or you are looking to buy, sell, or invest right here in the Treasure Valley, please feel free to reach out to me. You can give me at area code 208-715-STAR. Again, that's 208-715-7827. Also, if you're looking to begin your shopping experience right now, please feel free to visit my website at www.yourstarrealtor.com and begin your shopping experience today. Also, if you're looking to relocate right here to the Treasure Valley or the greater Boise, Idaho area, don't forget to click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Please feel free to comment below. Love to hear your thoughts. Click that subscribe button so that you're constantly tuned to all the videos that I do come up with, and hit that notification bell so that you're in tune when they do. Well, thanks again very much for taking the time out of your day to watch this video. I look forward to hearing from you. Look forward to the day we speak. Look forward to calling you my neighbor. God bless. We'll talk then. Thank you so much. Bye-bye.